Hello everyone, my name's Harry Thompson and I'll be running through our Q4 review and outlook. Before I start, I wanted to highlight we celebrated our 20th anniversary in Q4 last year. So it was back in 2002 that Wayne Bishop began running bespoke portfolios for ethically minded clients, and many of whom are still with us today. So we'd like to thank all of our clients, old and new, and we look forward to continuing to work alongside you. "30 years on from the late Queen's infamous Annus Horribilis speech, we look back over the last 12 months in a similar vein. It has been a particularly difficult year for investors, characterised by a number of events that have sent shockwaves through society. The ongoing atrocities of Russia in the Ukraine and the effect it had on already rising inflation hit both equity and bond markets at the start of the year and reverberated all the way through. Economists estimate that the conflict was responsible for about a third of the increase in inflation seen around the world due to its influence on food and energy prices, although we have begun to see some of these effects wane. We consider it a fool's errand to attempt to predict the timing or final outcome of the conflict in Ukraine, but as the shock factors fade, without any further escalation, its impact on market sentiment is declining. Let's briefly look back over the year and why this has been such a difficult year for investors. Much has been covered on these points in previous communications, but to recap, global inflation accelerated as the world came out of the COVID crisis, as seen by the top left graph, which highlights the UK inflation rate since 2017. These price pressures accelerated higher following the Russian invasion of Ukraine, which impacted energy and food in particular, leading to rises in wages in a hot labour market. Central banks were suddenly playing catch-up to try and tame inflation, given they delayed tightening monetary policy at the end of 2021 due to concerns over the Omicron variant. This led to rapid action from global central banks to tighten monetary policy. This firstly came through interest rate hikes, as seen by the bottom right graph, which shows the jump higher in the UK benchmark interest rate, and then subsequently the winding down of central bank balance sheets, drying up liquidity by selling down assets in a process known as quantitative tightening. Despite a rally in Q4, most asset classes finished the year in negative territory, as seen by the chart which plots a broad global equity index, a sterling corporate bond index, and a UK property index. On top of this, growth equities underperformed value, given the rise in the discount rate which feeds into the valuation of equities. Given many ESG and impact companies fit a growth profile, with the bulk of cash flows in the years to come, they reversed many of the prior year's gains, meaning it was a particularly tough year for investors. On top of this, whilst in previous years it had benefited investors, the negative screen applied, i.e. the avoidance of certain sectors, caused some underperformance versus the wider market, as a number of sectors traditionally screened from ethical portfolios, such as tobacco and defence, had a stellar year of performance, whilst other sectors, which can also be excluded, such as oil and gas, also outperformed. Looking ahead, three factors will drive the economic background for 2023: inflation, economic growth, and derived from these two, the current and anticipated level of interest rates in major global economies. We'll take a look at some of these points now. In the case of food prices, the conflict was another problem on top of the weather-related stresses that had already reduced crop harvests in Europe and North America. Furthermore, seasonal factors such as Christmas were exploited, leading to a spike in food inflation, which we do expect to level off over time. In general, we have already seen prices decline, albeit still well above pre-COVID levels, as seen by the UN Food and Ag Index on the top right. Meanwhile, energy prices have been in decline since September, and there are signs that this decline is accelerating as the warmer winter in the Northern Hemisphere reduces gas demand further. This is reflected in the UK gas price chart on the bottom left. Whilst this takes some time to feed through to consumers, the trend is clear. Two of the leading drivers of inflation appear to be in retreat, so it was no surprise that the UK Prime Minister picked the first week of 2023 to promise to reduce inflation. Although it seems like an age ago, it was in fact only a year ago that interest rate expectations began to impact the market. The Bank of England only began to normalise rates in December 2021, before beginning a more aggressive rise in February 22 and then higher to the current 3.5% level. Likewise, the Federal Reserve began raising rates in March 22, whilst the European Central Bank only began at the end of July 22. Whilst the impact of rate rises and expectations in bond and equity markets are instantaneous in terms of price action, the impact on the real economy takes up to a year, meaning we are only beginning to see the full effects of those early rate rises. The fact that interest rate rises of this speed have not been seen since the late 1970s, coupled with the squeeze suffered by higher energy and food prices, this leaves the market in uncharted territory. As a result, we head into the fourth quarter reporting period with low expectations. As mentioned, interest rates are pivotal in both bond and equity market pricing, and whilst the interest rate scenario has cooled and come back to reality, bond markets may still have an eventful year. The volatility experienced in the UK gilt market in the second half of 2022 reminds us that bond markets should not be considered magic bonds. Buyers of fixed income have emerged, as at least fixed income is offering some returns again compared to nothing last year. For example, 10-year yields at the year end were around 3.8% in the US and 3.6% in the UK, as highlighted in the top left graph. In the EU, they range from around 2 to 5% in the 10-year area, as highlighted by the bottom right graph showing the German and Italian 10-year government bonds, with the Italian bond obviously being the top blue line. Although these levels do not currently beat inflation, this may change. Therefore, we expect short-term interest rates to be more stable and any volatility in markets to be focused more on quality, given the likely recession scenario we'll face later in the year. This is particularly poignant in Europe, where peripheral debt, such as Italy, has climbed to levels not seen since the European debt crisis. With central banks no longer blanket buying bonds and the ECB now joining the BOE and the Fed in quantitative tightening, fixed income is going to need to find buyers again, at a time when large budget deficits imply there is higher supply than last year. Fears of a general slowdown have been growing for some time. As you can see from the graph, economic forecasts of global GDP growth have tumbled over the last 12 months. The impact being focused on discretionary spending and consumer sectors, particularly where there is exposure to housing, retail, hospitality and leisure. Recent results have shown some of these fears may have been overdone. However, in our view, the full impact and changes in consumer behaviour are likely to be felt in the coming year. As mentioned, the interest rate scenario has cooled somewhat, and this more stable setting, i.e. where the bulk of rates are in the rearview mirror, will provide a firmer basis for growth-focused equities. The energy shock created by the invasion of Ukraine initially led to much higher oil and gas prices, but despite the ongoing war, prices have fallen below pre-war levels. A great deal of money and effort has gone into ensuring gas supplies in Europe, and it's no surprise that interest in alternative and non-geopolitical sensitive energy sources has risen. Whilst the crisis slowed down the clean energy transition at the start, in the longer term it is speeding the process up. Answering renewable energy's key drawback has also moved a step closer, as both hydrogen and battery storage continue to develop. As you all know, renewable energy is a core component of portfolios, from manufacturing and development through to owning and operating of renewable energy generation. Despite suffering in 21 and 22, we have stuck with investments in this area, such as Vestas wind systems. Despite short-term issues around input costs and supply chains, in the last quarter we have seen a solid recovery and a positive year of returns. We have seen this with the renewable infrastructure investments as well, which experienced volatility and downward pressure around the turmoil of the Kwarteng mini budget in the UK. However, they too have recovered, and the appeal of holding infrastructure investments in the energy space is still intact. Mobility is one area we wanted to highlight given the concerns in this space over the last couple of years. With regards to public transport, where exposure is gained through bonds and equities, operators of transport such as buses have suffered due to labour and fuel costs and less predictable demand. We feel this area is in peak pessimism, particularly as leisure travel picks up. Whilst fuel costs are falling, the need for fossil fuels in this sector will decline, as investments in this area increase the drive to sustainable methods, such as electric buses or hydrogen trains. Elsewhere, electric cars have had a difficult year. Supply chains and costs remain a difficulty for this sector, and although growth is not as fast as expected, we still see the sector growing. Recent statistics have highlighted electric cars are now outselling diesel in the UK, albeit from corporates switching their fleets. We see the sector regaining its poise in the coming years, and infrastructure to support this will be vital. Here, portfolios have exposure to companies providing charging infrastructure for EVs, but also buses and coaches. This includes companies providing solutions for energy management to ensure grids are smart and can cope with the increased demand. And finally, our summary and outlook. The last quarter of 2022 has been a pivotal quarter. The main source of volatility, interest rate concerns, have levelled off. The first shockwaves from early 2022 in the energy sector have turned from headwinds in favour of fossil fuels to a determination to speed up the transition. Supply chains are being reinvented, meaning areas where we currently still have some turmoil, such as electric vehicles, mobility, infrastructure and property, are seeing some light at the end of the tunnel and are now presenting more investment opportunities. In these cases, the rethinking favours more ESG and impact-focused solutions. Whilst the interest rate turmoil is abating, the impact of higher rates is becoming clearer, and we expect this to make some unsettling headlines once the holiday period and New Year euphoria abates. Geopolitical tensions and uncertainty will remain a significant noise and influence over the year, but it would take a lot to match the shocks we absorbed in 2022. For the model portfolios, we start the year near the lower end of our equity allocation for each risk profile. This does inevitably mean that the next move in equities is higher, although given the alternative that bonds offer, we now have more investment options versus prior years. In bespoke portfolios, we've been able to de-risk clients by switching from holding a company's equity to buying their bonds, and this thinking will inevitably feed into the investment decisions made for model portfolios. The move higher in our equity allocation is unlikely until we get greater clarity on central bank direction. The pivot point would obviously be beneficial to growth equities, which plays into the flavour of many more impact-focused equities. So whilst any moves higher would be incremental, we'd likely favour impact funds and impact companies moving forward. This marks the end of the presentation. If you do have any questions, please reach out to your King & Shaxson contact. Thank you for listening.